Hello and welcome to the Movers and Shakers podcast. My name is Gino Barbaro, co-founder of Jake and Gino, multifamily investor, educator, father, and mentor. Today's guest is Vince Gethings, former Jake and Gino student and current Jake and Gino coach. In just 6 years, Vince has scaled from a $0 down payment VA home loan to over 570 apartment units valued at over $40 million. He's the owner of Michigan-based Villanatics, co-founder of Tri-City Equity Group, and the owner of Koala Insulation of Mid-Michigan. Say that again, Koala Insulation, a 12-territory home services franchise. Vince utilizes his 16 years of Air Force leadership experience, as well as the countless professional development courses, to build high-performing teams and efficient systems and processes. Welcome to the show, Mr. Vince Gethings.
Thanks for having me on, Gino. Always excited to be here.
It's been a while. Listen, you did a masterclass Monday with the students this past week. You shared your story. We talked about all the different strategies you're going. Just give the listeners a background of how you got into real estate and why multifamily for you, and touch upon you're out of state in Hawaii and you're doing stuff on the mainland. Let's talk about that as well.
Yeah, absolutely. So, give you a quick recap. So the zero down VA home loan. So while I was in the Air Force, I was actually stationed in California at the time. It was like 2013. Used my VA home loan to buy essentially the crappiest house on the block that will still pass the VA inspection, and we did a live-in flip with that house. And that was from 2013 to about 2016. At that time, that was the only real estate experience that I had, was just kind of flipping that house while I lived there. And then we sold that in 2016. And then that's when I started getting interested in real estate and got on. At the time, all I knew was like Bigger Pockets. So I got on Bigger Pockets, reading the forums. And I was like, this is what I want to do. So we sold that house, took all that equity or that cash, liquidated my brokerage accounts, my retirement accounts, everything. And I went full into real estate in 2016. And at the time, again, all I knew was Bigger Pockets. So they weren't really doing anything big at that time. If you remember kind of back in those days where it was like the Brandon Turner duplexes, fourplexes, kind of that's, what was out there. So I took that money, bought 20 duplexes and fourplexes, 20 units on my own in Michigan while I was stationed at Travis Air Force Base in California. And then from there, I kind of hit a ceiling, and essentially I ran out of money to keep buying more real estate. And I realized that there was still gaps in my education, and I didn't know what I didn't know. I saw online that there was people closing bigger deals, and I didn't know how they were doing it. But I know there was a way to do it. So that's when I started going back to education, bought a couple books. And then that's when I found the Wheelbarrow Profits Academy, asked around. And at the time I was kind of looking at all of them. There was a few big groups out there, and I was asking around, and everybody said Jake and Gino is the way to go. That's where you want to go. So I jumped on as a student in 2018 and the fall of 2018. And then right after that, within probably 6 months, we got my first big deal under contract. Again, I was still out of state. At this time I was in Hawaii, and my first deal as Jake and Gino student, my first multifamily, was from Hawaii, buying a 52 unit apartment complex in Michigan as a joint venture, me and 3 other people. And that went great. It was a good learning experience. It was probably a lot more work I had to do up front because I was out of state. But it really forced me to create the systems and processes, because I couldn't be there to kind of roll up my sleeves and do the work myself. It wasn't an option. So when you're in that position, you're forced to create systems and processes and teams to be successful. So that helped me out, even though it was a lot more work in the front end. It helped me scale a lot quicker because I already had those teams built and those system processes built. So I was able to scale very quickly after that deal. And that
How
was
old were you when you did that deal?
2018. Maybe, but I'm 34 now, so I'm bad at math. Was that 26, 27?
Yeah.
Like
Well, that's my point. You were young.
Yeah.
So for the listener right now, you're listening, you're saying, I don't have any money. I'm too young. I have a terrible market. Well, I mean, listen to what Vince is saying. He was 26, 27 when he got into his 52 unit property. He didn't have a ton of capital. he was living in Hawaii.
Mm-hmm.
Last time I saw, Hawaii is really not that close to Michigan, and there's really very few similarities between the two. So if you're thinking to yourself, well, I don't, the bottom line is Vince took massive action. He actually got the house, the VA house. He bought it. He created equity in that. From that, he went and rolled it into the 22 duplexes.
Mm-hmm.
From there, he said, I've got a problem. I need to scale up. What I'm doing currently right now is we're not working. I need to find the next iteration. And that's what he did. He came to Multifamily Mastery 2. He met all the people in the area. He's like, listen, I got to find a group, whether it's Jake and Gino or any kind of mentorship group, you need to join because there's going to be people there who have done what you want to do. There's going to be networking. There's going to be relationships. There's going to be things that you didn't know. You're like, wow, I didn't even know I could do something like that. How can I buy a 52-unit property without the capital? Well, maybe you can syndicate the deal, or maybe you can bring on additional partners, or maybe you can use seller financing. There's so many, I think, ideas that we've put in our heads to stop us from taking massive action. And I love your story because there's very little for excuses left to make. Whether you don't have the market, you don't have the capital, you don't have the experience, you're too young. So you've bought the 52 units, you're continuing along. And then after that, Vince, what's the next step in your journey after that?
So the next one was we did the 52 unit, and that was kind of the rest of my capital I have. And I'm like, okay, well, we did the JV. That's going to take a couple years to go full cycle. So how are we going to get the next deal? So that's when I was kind of full swing in Jake and Gino, and going to different conferences and all the kind of the conference circuit around the country, and doing all those learning and learning and learning. And then I learned about syndications. Like, hey, let's try syndications. That seems to be the tool to solve this problem. Where we have the experience now. We got the 52 unit that's pretty much stabilized at this point. It's been 6 months, and we stabilized it. We have the systems and processes built. We have the management teams built. So let's try a hand in syndication. Let's find a small one in a pretty safe market. So we chose El Paso, which is a really stable market. It's recession resistant, but it's also generally low income. So we were able to get a 48 unit property there at really low cost basis. But on the downside of that, didn't have a whole lot of downside risk that we saw in our market evaluation if the recession was going to come, because we bought that rate during the beginning of COVID. And that turned out to be great for us. So that was our first syndication. It was like $1.5 million. So again, baby steps into that. We didn't just jump right into some $10 million syndication or anything like that. We started a small one where we knew we could handle it. We knew it was in a market that it's not a boom and bust market. It was a very stable market. And it was pretty much a textbook C-class reposition is what we did. And we were able to get in and get out of that property. And that gave us the experience of how to do a syndication, go through all those steps and build those processes out. And then from there, we scaled pretty quickly after that first one, or after that first one was stabilized, Gateway in El Paso. Once that one was stabilized, and we're like, okay, we worked out the kinks that we know of, and now we can. So it was about 6 months later. We're like, okay, now we're ready to scale and get a little bit bigger properties, a little bit higher price points, and we're confident that we can handle that. So then after that first syndication is when it went pretty fast. We bought maybe 8 or 10 more properties in the next 2 years.
Wow. And
After
when
that
you
first.
did that, Vince, as you're doing that, you're doing buy right, manage right, finance right, because you're buying these properties right on the front end, you're financing them properly. And obviously, the managed systems are important. What problems did you have before joining Jake and Gino? I just listed a couple, but what other mental limiting beliefs, what other blocks did you have? What other challenges did you have before you joined?
So before I joined, a lot of it was the limiting beliefs, not on my own. I did, obviously I have a bunch, and I still have a bunch. But it was a more so the limiting beliefs of the people I was around. And I was going at that time, I was still going to like my local RIAs and things like that in California, because I had the 20 units, and outside of multifamily, like 20 units is a lot for most people. And like, so I thought, I was like, man, I'm crushing. I got 20 units and everything's great. And I'm, doing, the Brandon Turner books and everything like that. So I'm like managing great, and everything's great. And then I think one of the things that stuck with me, and this is actually this is a conversation I had at my local RIA, which was like one of those decision points, the light bulb moments. I was talking to an older gentleman, probably now 60s or 70s. And he's like, you're doing great. Just another, 100 more duplexes and you can retire. And I was like, I haven't slept in like, in like 16 months just to buy the 20 I have, just, doing all the market research and closing deals. That's, 7 different loans and everything like that just to get the 20 units. And he's like, I'm on a good path and 100 more and I can retire. And I was just like,
That guy should have joined Jake and Gino. I'm
right,
sorry, Vince.
it literally just took the wind out of my sails for like the last couple months. And I was like, I worked so hard just to get the 20 units. And this guy's like, yeah, I got 20 years ahead buying that type of product. And that's when I was like, all right, there's something else out there like that can shorten this curve to that
Mhm.
financial freedom or early retirement and all those things. And that's when I was like, all right, there's got to be something else out there. There's got to be another group because I'm seeing the results, on social media and things like that. And people I know saying, oh, this person, they just bought a apartment. I'm like, okay, there's something I'm missing. I need to know. And that's what it was. So I leveled up my community, leveled up my circle, and it was like rocket fuel. It was just,
Mhm.
the limiting beliefs were shed almost immediately when it comes to, do I have what it takes to do these things? Absolutely, because there's, I don't know, 900 people that are doing the exact same thing, or however many is in the community now. Um,
Mhm.
and that was a big thing. But yeah, so that was kind of the local RIA, and you got your local, real estate people. And I was in that was a Sacramento, California RIA, so not a small market, Midwest market. It was a pretty big central city real estate meetup, and that was like kind of the mentality there was just like, plink off, single families here and there and duplexes here and there, and that'll work for some people, but that wasn't what I wanted. I wanted to go faster, and I just
Let
didn't.
me ask you, Vince, when you are at that point and you have the decision to continue with your career or leave and retire, what was that conversation like? What were you saying to yourself?
For me, it's a little bit different. So being in the military, when it comes to career, I have a glass ceiling, or not a glass ceiling. I have a hard ceiling, like a brick wall for a 6 foot cement ceiling. I know exactly how far I can go because it's literally written into law by Congress. Like I was enlisted,
Isn't
so I
that
was.
depressing? Is that depressing or not?
It is once you start getting up there, and so I made E7, so which is a master sergeant in the Air Force, pretty quickly. Like 10 years, I got selected. I had it on in 11 years, which is a little bit faster than normal. Not nothing crazy, but it's a little bit faster than the average. But I have 20 years until retirement, and I'm already in E7, and the scale only goes up to E9. So I only have 2 promotions left in the next 10 years, or a lot of people do 25 years. If they're getting up to chief master sergeant, 25, 30 years is not uncommon. And I'm already like an E7. So I'm like looking at my pay chart and I'm like, the most I will ever make to the penny is this much. And that's it. And I have a good chance of making that in the next, 6 or 7 years. And then that's it for me. So when I'm looking at that, the opportunity cost, I think everything in opportunity cost, this decision versus this decision, or this decision versus infinite decisions. And it was really hard at first, to kind of plant that seed of, will you give up a government pension? Because that's like the holy grail of pensions, is the government 20-year pension. And I was at 15 years by the time I finally made the, or yeah, 15 years by the time I finally made the decision. Like, I'm pulling chalks, and I'm going to go out and I'm going to burn the ships. And so that was like kind of the one mental decision, was like, the depressing part of it was like, E9 was all I'll ever be able to make, and that is the top of my potential, and I'll never really know what I'm capable of, because by the time I get out, I'll be 40 something years old, and then trying to reach my full potential in my 40s. So that was kind of one thing that was kind of weighing on my mind, is what am I really capable of? Will I ever have a chance to reach my full potential before I get a little older? Or against the other side of it was, Tri-City was starting to scale very fast, because the whole time I was doing full-time military and full-time Tri-City, buying apartments around the country, and Tri-City scaled up. We At that time we had 400 something units, 500 units, and then that was becoming a full-time thing as well. So
Wow.
at some point it was sitting down and reflecting, okay, like, here's the absolute top I can make if I stayed in the military, and then there is no top for real estate. It literally, as much as the team and the systems and process you can create, there's no limit.
Now, we have had a great run in multifamily, going from 0 units to over 250 million in assets. That's over 2,000 apartment deals that we've been able to purchase through our framework: buy right, manage right, and finance right.
Now, Jake and I, we created the Jake and Gino community back in 2015. We launched our first book, Wheelbarrow Profits. And since then, our students have closed over 60,000 units. That's over $4 billion in assets they've been able to close over the last 6 years.
And that's why this community has been so successful. We call it results-based education, and we pour back into the community everything that we've learned on our journey from 0 to 2,000 units, and all our systems and scale that we use on our very own property management and investing companies.
Jake, I love that. It's not just education, it's implementation. So what I want you to do, click on that link down below, apply to work with our team, see how we can help you on your journey in multifamily. What were the challenges when you retired, though? I mean, there must have been some challenges because all of a sudden you go from a structured life, you go from, and it's funny because when you're that busy, you are that focused and you get that much stuff done. When you leave one of your professions, it's like, I got all this time now. What do I do? It's like, it must have been a tough transition for you to leave and say, okay, I'm leaving that structure and now I've got a full-time entrepreneur.
I'm not great at that, so I'm still working that out. Obviously, I've read all the books. I've read the one thing and getting things done, and so I've read all the books. I start the time blocking thing, and I'm okay. I'm manageable, but I'm not like some super regimented entrepreneur that I could be. It's a work in progress. But
Yeah,
a lot of it is,
but yet you still have the installation businesses and you're scaling that. You still have the syndication business, you're scaling that. You still have investors, you do the project management, you still have your little portfolio. So I think you're, I guess, above average. You're not great, maybe, let's just say, but you're not too bad at it. So how did you transition? What was the transition? What did you do? You've read the books, you said, but what, like, man, to get this stuff done, what did you end up doing?
a lot of it for me, my personality, I think the time blocking, even if you can stick to it and have the discipline to stick to time blocking or not, but going and printing out a weekly, like just paper of what a week looks like by the hours, and sitting there for a night and time blocking your activities of what your intentions are for those blocks, and then trying to stay to them, you're going to be way more productive than if you didn't do that. Even if you have a time block for, okay, this is my Tri-City Equity time block for 4 hours, and even if I get distracted and I have to make a couple phone calls for Koala or Villanotics or something like that, or pick the kids up and go to soccer, I still got more done because I had that block on my calendar. So I had it started and I got through a big portion of it, but I usually get distracted from something. So that's why I said I'm not an expert at it, because there's people that like time block and it's like they have 100% discipline. Like, I'm not answering my phone.
They've been doing it for
I'm not
years.
doing anything. I can start every day with my time blocks, but I usually get distracted at some point. So it's a work in progress. So I think that's important. And then having some kind of app, we have enough apps out there to keep you, like Asana or Monday.com or any of those, where you can create these battle rhythms. And that's really, really important too, is to create these recurring tasks where every week or every day it pops up, and that way you don't have to try to mentally remember, the 150 things you have to do every day as an entrepreneur. It's, you create these rhythms in these apps like Asana or Monday. There's probably a ton of other ones, and it just helps that, like, the checklist just pop up and it's like, all right, this is due today, this is due this week, this is due this month, and then you click complete, and it automatically auto populates the next month or the next week. So creating those systems and processes, and it takes a lot of time up front. But the best thing to do is just go, even if you have to like go rent a hotel for a night, just so you're not distracted, and like, okay, I'm going to go get a hotel for the night, and all I'm going to do is just focus on building my time block schedule and focus on building these battle rhythms in Asana or Monday. You're going to be way more productive than you ever were, just by having those in place. Even if you don't have the discipline, the discipline can be built over time. But
I love that.
I think is really good.
Yeah, well, that's what we do. The podcast, we schedule podcasts certain days. We have 4 different shows. It's on that day. We have our weekly L10 meetings. They're on that day. The weekly huddle every morning is on that time. Our daily huddles are on that time. So that's very, very important as far as getting what we call that cadence of accountability.
Yep.
Now, you are the personification of what we call the conveyor belt theory. The conveyor belt is getting assets on this imaginary belt, stacking the belt, letting that equity matriculate and pulling it out from that one little tiny VA home back in 2013. Then you go to the 20 units, then from the 20 units to the 52, and from the 52 going to El Paso, the 48, and then continue to scale up. You had said to me before we started recording, you're cycling out of deals. You're actually, I've understood it real quick that real estate's a business.
Mm-hmm.
You're really a multifamily entrepreneur. You're not just buying assets. You're accumulating that business mentality of some of them are really good and some of them aren't. And if I've made money, let me pull the capital out and put into ones that really work. Can you describe your journey and your thought processes of what made you decide, what made you realize, wow, I've got the ability to take some of these deals out. They don't make sense. And let me start buying some of these other types of deals.
Yeah, absolutely. So, COVID really kind of opened our eyes up to this. So at first, a lot of people, especially if they're newer, they kind of see the real estate industry or game or whatever it is as far as investing, almost like some kind of ladder or something of sophistication. Like, okay, you got to start with
Mm-hmm.
wholesaling, and then you go to single family flipping, and then maybe small multifamilies, and then large
So
multifamily.
you're saying you don't have to do that. Is that what you're saying? Like
That's
we
exactly
think
what I'm
that.
saying. That was the
Okay.
big epiphany, because then we went to
Okay.
JVs and then syndications and then the holy grail, like a fund or something like that at the top. And that's kind of like the image that's kind of out there for a lot of people. Like, I just need to get more sophisticated. I have to do syndications, and then I have to start a fund, and also, and then that's what we were doing. And then like the big kind of epiphany was like, we don't have to do any of that. Like, it's not like that at all. And then I mentally transitioned to kind of like a toolbox mentality of like, all of these strategies, or you just have to know a lot of strategies and how to take down a deal efficiently. Seller financing, master lease options, syndications, joint ventures, all these things is you just have to know how to do each one of these and either get a program or something like that, get the books on how to do these strategies. So when you see a deal, you see you'll be able to see a lot more opportunities, because now in your tool belt, you have a lot more tools that you can use. Maybe this deal won't be good for a JV. Maybe it's too big. You need to syndicate it, or maybe the deal is the capital markets aren't good right now. So you want to do some seller financing or a master lease option. Well, now you have that tool and you can bring out that tool. So now I've transitioned to a mentality of what is the most efficient strategy and tool that I can use to take this deal down. And that's how I look through every deal now. And so it's not like, and Bill Ham used this kind of example of like, or he uses the example of like the hammer. Like, if all you have is a hammer, everything's a nail kind of thing. And that's a lot of it. Like with the syndication world, it's like everything's a syndication. And now it's like, no, it's like that could be a master lease option, that can be seller financing, that can be a JV. Like, it's what is the most efficient way to take down that deal, and easiest way to take down that deal. And that's how I look through it now. And then coupling that with the conveyor belt, again, a lot of it was you just need to play the bigger, better. Trade the duplex in for a 4 unit, the 4 unit for a 10, a 10 for a 20, a 20 for 100, 100 for 300 unit deals. And like every deal needs to get bigger, or you're not progressing, in the eyes of whoever. So that was a lot of the mentality early on. Now it's not like that at all. I see everything now on that 5-year conveyor belt. I have a couple assets that kind of like the legacy properties or whatever, but that's a little different. But pretty much as a business, it's a 5-year conveyor belt, and I can put assets on there, and maybe I put a joint venture 10 unit on there. That one's off running. Then I put a 50 unit syndication or 100 unit syndication. That one's running. And then maybe I put a bunch of maybe a 10 unit local deal. Like, because before I was like, I'm not doing any 10 unit deals anymore. I'm doing 100 unit deals now. But then now I'm like, well, I'm stupid. Why would I give up? This is a great property. It's a 10 unit deal. It's a half mile from my house. Why would I not do that? But 2 years ago, I wouldn't have looked at those deals anymore, because I'm like, I'm only doing big deals. But now it's put assets on the conveyor belt. What's the most efficient way to take it down? Don't discriminate against the size of a deal. If the deal's good and it fits, what you're looking for, throw it on the conveyor belt. And then in 5, whatever it is, 3 years, 5 years, whenever those business cycles come out, you're building that equity up, and you're having those capital events either through a refinance or a sale. And then now you're liquid again, and now you buy a new asset. And it starts out slow. And for me, it was like between 2018 to 22, it was just putting assets on the conveyor belt. That's all I was doing, putting assets on the conveyor belt. But now we're starting to sell some of those. And the last half of 22, and then now we have 3 units, 3 complexes on the market. And I'm looking at the projections are up here on my whiteboard of what those cash injections back into me. Those liquidity events are going to be for me. And I'm like, holy crap, like this is awesome. So those first batch of assets I bought 3 years ago are finally coming off the back end of that conveyor belt. And it's pretty exciting to see. So now we're actually seeing that rocket fuel kind of curve up of now we're getting these huge liquidity events, and now we can transition to, as your business model shifts, which we can talk about next, into those next kind of iteration of assets that we're looking for.
Do you mind if I make 3 quick points on what you said?
Yep.
First one, I didn't make the term ROE. It was from Brian Alfaro. It's return on effort. And I know that Vince is going to touch upon this later, but he's putting in less effort on a lot of these deals just because a deal is really, really profitable. The 10 unit, there's not a lot of effort for a 10 unit, right? I mean, like it's 10 there, it's a half mile down the road. That may make sense. 2 years ago, to be like, it's not for me. But now, if he owns that 10 unit and also all his equity, he's putting it on the conveyor belt. I think the second thing, Vince realized, and a lot of us realize in real estate, you don't make money when you buy real estate. Everyone always says that you make money when you exit real estate, and that's either a refinance or a sale. You're going to make cash flow, and that's what we do. All these deals that we're stacking, but the real big payday is when you exit that deal through a refi or through a sale. And the third thing is Vince is being modest. He's also stacking businesses on his conveyor belt. He's got the koala business going, and the insurance business, which he's stacking on there. And that's another asset. I would say put some whole life insurance on there. Yep. That's another asset that you're stacking on there as well. You can go out and buy another business. I mean, there's so many ideas. The conveyor belt, I think, is just one of those things where you have mentally, and what you're trying to do is to stack it and try to create equity. And through that crystallization of the equity and being able to pull it out and to repurpose it into other assets is important. Because you know what? Vince is not going out buying a Lambo. He never said anything about buying, luxuries. He's reinvesting a lot of this money back into the businesses. So within the next 5 years, all that excess cash flow coming from those businesses, he can do whatever he wants. He can fund his lifestyle. But in the short run, the first 3-4 years of building the business, it's really, really important to reinvest those funds. I know you wanted to touch upon that next segment of what you were talking about. If you have any other comments, I'd love to hear them as well.
No, that's absolutely right. So building the conveyor belt is all I focus on now. Is this going to be an asset that I throw in the conveyor belt or not? And is it going to serve me for my business plan? And as far as the return on effort, that's exactly where I was going to transition next. So when I got into real estate, and this is a big mistake most new people make, is they get into teams they shouldn't get into because they get they get their itis, in Jake's words. They get their itis of like they want to get into a deal, and they're going to hop into bed with these people that they don't really know. They don't know what their morals, ethics, and values are, what their timeline and what their goals are, but they want to buy a deal in wherever, Oklahoma. So they find a couple people they barely know, and they go buy a deal in Oklahoma together. And 6 months later, everybody hates each other, and it's horrible. So having the teams is really important. But then another one for me is, a lot of people, they think the grass is greener, somewhere else. Like they might be living in Dallas or something like that, and they're trying to invest in, the Twin Cities or something like that. I'm like, why? Like, and I get on the call, I'm like, why? You're in one of the best markets in the country. The grass isn't greener. You're making that effort, even though the deal might pencil out better on paper for you to go out of your market. That effort that it's going to require to manage that asset so far away, if you don't have to. My case was a little bit different because I was in the military, and so I'm moving every 3 or 4 years, so I couldn't put down roots in California and like, okay, I'm going to build a portfolio in California or build a portfolio in Hawaii because there were, it's 2 caps out there. So I was kind of forced to go out of state to find anything that was remotely good. But most people that I'm talking to, they're in good markets, but they get the grass is green. Oh, I got to go to the Sun Belt. I got to go to this. I'm like, have you tried doing a 3-hour radius around your house and doing market research around your house? So that's always where I go first now is, look around your house first. What's your home base? You have a competitive advantage there. You know the industries, you know the markets, you know where everybody works. You just need to do a little bit of education on how to figure out the actual data and analytics of that. But you should always look around your house first, 3 hours or whatever radius. And if nothing else is like nothing works, it's not good. Maybe like by San Francisco or something like that, then you should look at out of state. For me, I just did like this mile. And here's an example of that return on effort. I did a mile wide effort. So I went really wide, really fast. And I was in like 5 states managing 12 different apartment complexes. And I was able to scale very quickly because I cast a really wide net. So I was able to find a bunch of deals that penciled out on paper. And otherwise, they'd be great deals. However, I became my own bottleneck because the effort that's required to manage all of these assets across all these different markets, 5 different states, 4 different property management companies, um, that effort was kind of draining because there was no efficiencies there in like the overhead. Like I wasn't able to use the same property managers and stuff like that and same contractors. So it doesn't sound like a lot, but when we were doing a really big deep dive of in 22 of like what properties in our portfolio performed really well and what ones kind of sucked the life out of us. And a lot of them were like these single assets in these states that we don't have any other assets there. Like as an individual asset, that was a good deal. But in a portfolio, it was taking so much of my energy for this one asset that I didn't have the bandwidth to continue to buy more properties. So going a mile wide and you're like, I'm just going to cast a big net and I'm going to go anywhere a deal works. I'll buy a deal in Florida, and then I'll buy a deal in Texas, and I'll buy a deal in Oklahoma or Kansas City or whatever. That I normally a couple years ago I would have said go for it, go where the deal makes sense. Now I'm like that's a bad idea. I've lived it. You want to go, you want to pick maybe 1 or 2 markets and go a mile deep. You want to know everything there is to know about them, and you want to build your teams and your systems processes in there because as you start scaling, you're going to be able to take advantage of the efficiencies of being able to do that. So mentally, and that's the part that it's not in the books about this kind of mental fatigue and bandwidth. Everything's a lot more about like the numbers. You're going to hit a wall and a bottleneck in your efficiencies because you're not going to have the bandwidth to manage, or most people are not going to have the bandwidth to manage 12 different assets in 6 different states without being stressed out all the time. And you're constantly having to find all contractors and different legal teams for everything because you have to know the different landlord tenant laws for different states. All the taxes are different and calculated different. So it doesn't sound like that much, but I'm telling you, it is. It's a lot harder to go a mile wide, even though you're going to be able to get more deals faster. It's much better to pick a couple good markets and go a mile deep. And that's what we're doing now. And that return on effort from Brian that you were talking about is we're putting way too much effort in these assets that are kind of spread out. So we're selling off all of those and we're going a mile deep. Texas is one of our key markets, and we're going to go a mile deep into the Dallas DFW area, and we're already seeing the benefits of that by having one legal team, one tax team, one property management team, one or 2 or 3 sets of contractors, but they can all share. So our economies of scale is really ramping up there, and we've proved that concept. And then obviously the big hit in the head I got was listening to Logan Rankin and his phenomenal story and meeting him about him going a mile deep. And I was like, all right, we're going to do this because that's exactly what it came out in our 22 end of year deep dive was we need to stop going a mile wide. We need to tighten up, go a mile deep, focus on efficiencies. And those things are starting to take off now. And we're really starting to see the benefit of that.
I love that. There's 3 types of people that really benefit from the Jake and Gino community. The first one is if you're a professional, you're a small business owner, you're a doctor, you're an attorney, you know that multifamily is a place to go. The second one is residential. If you're a single family investor, wholesaler. The third one is what Vince has done. He is into the small multifamily. He owned 20 units. He knew that there was the opportunity for the scale. He just didn't know how to. So if you're one of those 3, just go to jakeandgino.com/apply and apply to work with the team. See how we can help you scale your multifamily or either get into it. Vince, if you're starting off again with all the stuff that you know right now and you're listening to the show, what would you tell the listener who's maybe has a wholesaling business? He maybe has 3 single family homes. He's fixing and flipping, or he has 10 or 12 units. What would you say the first few steps that person needs to take to become serious to get into multifamily?
Definitely join a mastermind. I think that's foundational. That's where I shifted. Going to the free local kind of RIA things like that, or the local events, to like a real mastermind that's structured and has that community. That was the first like rocket moment I had. And then the second one is like I said, don't get that the grass is greener syndrome, and focus on the city you're in, and maybe, a couple hours around it, and focus on finding assets that are building, getting to know all the brokers there, all the agents there, all the insurance companies there, all the lenders there, because you have a competitive advantage in that market. Because a lot of people spend so much time trying to go to these other markets where the grass is greener, and they end up buying subpar deals that are harder to manage. So focus on where you have a competitive advantage, where you live, join a good mastermind, and I think that's probably where I would start, in going there. Yeah.
I love that. Before we wrap up the show, what is on the horizon for Vince Gethings? And obviously, I want you to tell people where they can reach, where they can get in touch with you.
Yeah, absolutely. So on the horizon, for Vince Gethings, so I have my franchise. We're scaling that up. We're really excited about that. Is getting that scaled up. I have a couple good mentors on that, like Duran, and getting in that company really stable. For Tri-City, we're restructuring our entire portfolio to buy nicer, quality product, in one or two good markets, rather than trying to buy anything anywhere that pencils out. So we're really tightening up and going a mile deep in Tri-City. So big things in Tri-City are coming. And then we got that the conference in Hawaii, the Hawaii Millionaire Mindset Conference, June 29th to July 2nd on the Big Island, Hawaii. So if you're interested in coming out, hanging out with us, breaking bread in paradise, come out, reach out
What's
to me.
email?
Yeah.
Email address, websites?
Yeah. So my email is vincent@tricityequity.com. We have tricityequity.com is our domain. And then we also have the Hawaii Millionaire Mindset.com for that event out there as well.
HawaiiMillionaireMindset.com. I went to the event last year, took the whole family. It was freaking phenomenal. If you've never been to Hawaii, you should absolutely go. The event was great because you see it from a different perspective. When you're there, there's so many different entrepreneurs. It's not just real estate. You're seeing people building businesses. You're seeing people wanting to aspire to become entrepreneurs. I wish I had enough time to really wrap up the show, because I could spend 30 minutes just wrapping up Vince's journey. And for those of you out there that say you don't have the time, you don't have the money, you don't have the experience, you're too young, you're just making excuses for yourself. And that's okay. You're just maybe not ready to jump into real estate, because Vince has had a tough week. I mean, he's going through refis right now. He's getting kicked in the teeth. He actually spent time with me on Monday at a master class. But you know what? The great thing about it is, this week's over. He's going to get back at it next week. You either have a brick ceiling with the military, or you have an unlimited ceiling with yourself. You have that choice. And I think, me personally, Vince made the right choice. And I think he makes the right choice too, because I see the guy, he's always happy now. He's always thinking about the next project. He's motivated. He's inspired. He's got a ton of passion. I thought he was nuts for buying the businesses, but now I'm like, wow, that made a lot of sense, because now he's got that other asset that he can leverage. He's using great debt on that. He bought that asset right. He's managing it right, and he's financing it right. So I just want to give a big shout out to Vince Gethings once again. Hawaii Millionaire, give me the website again.
The Hawaii Millionaires Mindset.
Hawaii Millionaires Mindset. Go check Vince out. And I just want to thank you for spending some time with me today, Vince. I know you got to get back to work. You got a couple of refis going on. And I just want to thank the listeners for spending some time today. Go out there and let's make it and make it happen to everyone. Take care, Vince.
Yep, you too, Gino.